BlackRock stock is currently trading at 1,148.11 cents USD, up 56.29 or 5.16% today. While most investors are fixated on the massive $14 trillion assets under management headline that just crossed the wires, the real surprise tucked away in today's report is the acceleration of organic base fees, which hit a 12% growth rate in the fourth quarter. For a company that essentially functions as the plumbing of the global financial system, seeing that kind of double-digit organic growth is almost unheard of and completely shatters the narrative that this firm is too big to move the needle. Most people look at a giant like this and expect slow, steady, utility-like performance, but the reality we are seeing in the tape right now suggests a much more aggressive expansion into high-margin private markets that is catching the bears off guard. The expectation in the market for months has been that high interest rates would eventually choke off institutional inflows, and that the shift toward passive investing would continue to compress margins until there was nothing left. We have seen this reflected in how people talk about the broader financial sector, where the assumption is that the easy wins are over. But the reality is that BlackRock stock is currently defying that gravity by proving they can pivot faster than the smaller players. By integrating platforms like Global Infrastructure Partners and HPS, they are no longer just the world's largest index fund provider, they are becoming a private credit powerhouse. This is a massive shift from the common ground of seeing them as just a beta play for the S&P 500. If you look at the recent stock movement, the intraday surge of over 5% today is a direct reaction to a fourth-quarter earnings beat that saw adjusted earnings per share land at $13.16, significantly higher than the $12.30 consensus. This wasn't just a paper beat driven by tax maneuvers either. Revenue climbed over 23% year-over-year to $7.01 billion. What is really fueling the volume today is the institutional activity surrounding their long-term net inflows, which totaled $268 billion just in the last quarter. When you see big blocks of shares moving like this, it is usually a sign that major funds are reallocating into the name, realizing that the fee growth story is much stronger than anticipated. Trading volumes are hitting levels we haven't seen in months, and the momentum is clearly to the upside as we break through previous resistance levels near the $1,100 mark. If you've been watching Nvidia stock or Apple stock lately, you know that the market is rewarding companies that can show real, tangible earnings growth regardless of the macro environment. BlackRock is now firmly in that camp. While many retail investors are busy looking for the next big thing on the Robinhood app or through various investing sites, institutional players are piling into BlackRock because it provides a unique kind of safety combined with this newly discovered growth engine in private equity and infrastructure. It is worth noting that while the top line is screaming higher, total expenses also jumped about 48% this quarter. Ordinarily, that would be a red flag, but the market is looking past it because those costs are tied to the aggressive acquisition of HPS and the integration of Pre-Kin. Investors are making a bet that these costs are investments in a higher margin future. When you are doing your own online investing and managing an individual brokerage account, it is easy to get spooked by rising costs, but in this case, the market sees it as the price of admission for dominated the private credit space. If you are using something like the Fidelity mobile app or the SoFi trading platform to track your portfolio, you probably noticed the sector-wide lift today, as BlackRock's performance is acting as a rising tide for the entire asset management industry. Beyond the daily swings, we have to look at what this company actually does to understand why the scale matters. BlackRock is effectively a technology company masquerading as an asset manager. Their Aladdin platform is the secret sauce that keeps institutional clients locked in. It provides the risk management and portfolio construction tools that almost every major bank and pension fund relies on. This isn't just about mutual funds anymore. It is about providing the essential data that runs the world's portfolios. This is why even when markets are volatile, their technology services and subscription revenue continue to grow, providing a floor for the stock price that many other financial firms simply don't have. Historically, the company has always been a cash machine, but the mix is changing. In the past, about 80% of their assets were for institutional clients, and while that is still a huge part of the pie, they are making a massive push into retail wealth management channels. They are now pitching private credit strategies to the same types of advisors who might otherwise suggest Schwab Intelligent Portfolios or other robo-advisors. This move into the retail wealth space is a key catalyst for 2026 because it opens up a massive pool of capital that hasn't traditionally had access to institutional-grade private assets. If you are following the trend of online investment help and self-investing, you are likely seeing more people talk about alternative assets. BlackRock is the one providing the pipes for those assets to flow through. They are essentially democratizing access to things like infrastructure and private debt, which were previously reserved for the ultra-wealthy. This is a brilliant strategic move because these products carry much higher fees than your standard iShares ETF. It's the classic strategy of using a low-cost, high-volume product like an index fund to get clients in the door, then upselling them on higher-margin specialized services. Comment below how many shares of BlackRock you currently hold, or if you prefer other asset managers like Vanguard or State Street in this environment. Looking ahead to the rest of 2026, the catalysts are quite clear. We are entering a period where the mega forces that BlackRock often discusses, like the massive capital spending needed for the AI build-out and the global energy transition, require trillions of dollars in financing. BlackRock is positioning itself to be the primary intermediary for that capital. They are betting that the future of the global economy will be funded not just from bank loans, but from private credit and infrastructure funds. If they are right, the current record AUM of $14 trillion might just be the beginning. There are risks, of course. Macroeconomic pressures like sticky inflation could force the Federal Reserve to keep rates higher for longer, which might eventually dampen the enthusiasm for equities. However, the diversification of BlackRock's revenue streams, from technology fees to performance fees, provides a significant buffer. Even if the market goes sideways, the demand for risk management via Aladdin usually goes up. This is a classic example of a company that has built a moat so wide it is almost impossible for competitors to cross. When we talk about investment and managing money through a Fidelity brokerage account or an Interactive Brokers account, we often focus on individual stocks like Tesla stock. But companies like BlackRock represent the collective movement of all those individual pieces. They are the ones facilitating the liquidity and providing the structure for the entire market to function. The recent strength in the stock is a reflection of the market realizing that in a volatile world, the firm that manages the volatility is the one that wins. The institutional ownership of BlackRock remains incredibly high at over 75%, which tells you that the smart money is not going anywhere. They see the same thing we are seeing today, a company that is successfully transitioning from a pure passive index giant into a diversified financial powerhouse. The expectation was that they would eventually hit a ceiling. The reality is they just built a new floor. They are proving that scale can actually be a competitive advantage rather than a burden, provided you have the technology and the brand to back it up. As we wrap up the analysis of today's movement, remember that the gap between expectation and reality is where the biggest gains are often found. The market expected a decent quarter. BlackRock delivered a transformative one. They have managed to grow their dividend by 10% while simultaneously funding some of the largest acquisitions in their history. This shows a level of capital discipline that is rare in the market today. Whether you are using a SoFi active investing account or a more traditional Fidelity wealth management service, keeping an eye on the leaders of the sector is essential for understanding the broader market direction. The outlook for BlackRock remains tied to its ability to execute on these new private market initiatives. If they can maintain that double-digit organic fee growth, the valuation multiple will likely continue to expand. Currently, the PE ratio is hovering around 28 to 30, which is high for a traditional bank but perfectly reasonable for a high-growth fintech and asset management hybrid. The central insight here is that BlackRock is no longer just a proxy for the market, it is a growth story in its own right, fueled by a tectonic shift in how global capital is allocated. This is why the stock is seeing such a violent move to the upside today, and it's a narrative that likely has a lot more room to run as we move deeper into the year. The firm is essentially building a wall around its business by integrating data, technology, and diverse asset classes into a single unified platform. This is what they mean when they talk about Aladdin. It is not just software, it is a comprehensive ecosystem that makes it very difficult for clients to leave. This sticky revenue, combined with the explosive growth in new areas like private credit, creates a compounding effect that is very hard for any competitor to match. Even with the job cuts mentioned in recent